It's Saturday, 12th of October, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, does India's economic boom signal another commodities supercycle? But first, Neil Shearing, Group Chief Economist, joins me to rake over the coals of another week in global macro and markets, and to look ahead to the coming trading days. Hi there, Neil.
Hi, David.
We're speaking on a Saturday. Why? Because it's technically a working day in China. That's how they calculate their public holidays. Don't ask me. But Minister of Finance Lan Fo'an has just given a much anticipated press conference. Now, markets have been on tenterhooks for this one. This was the moment when the government would show its cards and reveal to the world just how much fiscal stimulus it was willing to throw at the economy to turn things around. Or was it? Neil, what's the big takeaway?
Well, the big takeaway, I think, is that there's still a number of questions that have been left unanswered. When the initial stimulus package broke on the newswires, the key question in our minds was not just the size of the package, but in particular, how would it be formed? And there was this sense from the market reports, the news reports, that there was going to be a pillar that would be about recapitalising the banks, a pillar that would be about trying to provide some support for local government, and a pillar of the fiscal support that was about supporting households and consumers. And to our minds, that was the really critical part. How much support would there be for households? And we're still waiting for some kind of clarification of exactly what the government is planning on that front. So what was announced today was a series of changes to the rules around how local governments can spend some of the debt that they've raised in markets this year. So they've relaxed some of the rules that have previously constrained local governments in that regard. So they can, for example, use those funds to buy unsold property, to buy unsold land and so on and so forth. That will help the property sector at the margin. And also, importantly, there's about 2.3 trillion renminbi funds that have yet to be spent this year. And the government has instructed local governments to spend that money by the end of the year. So that's going to give a bit of a boost to the economy over the coming months. And that, of course, is welcome. But we've not had really any detail of what the government is planning in terms of support for households. And that's the really disappointing part, because when the first reports of this fiscal package broke, the most interesting idea was the reports that there was going to be measures that would have direct transfers to households, particularly with two or more children, which would represent a major break from what we've seen in the past. And yeah, we're still waiting on detail and confirmation indeed of that. So it goes somewhere to clearing up unanswered questions about the package, but there's still an awful lot of questions unanswered, I'm afraid.
I guess the point here is that this might not be the final word in stimulus. We had earlier in the week that press conference from the National Development Reform Commission on Tuesday. There had been expectations going into that. That press conference wound up disappointing markets. Not enough detail there, not enough hard numbers. Hong Kong's stock market, the Hang Seng Index, fell 9.5% as a result of all of that. Here we are on Saturday. Again, lots of expectations going into this press conference. A lot of disappointment, as you've explained, in terms of the lack of hard numbers, lack of a sense of real expansion of fiscal policy. But it's important to stress that there could be more details in the coming days and weeks, right?
We could be, but look, I think there is always two parts to this. One was what's the overall scale and composition of the package, but also the extent to which it's coordinated across the different parts of China's government, central government. So you mentioned the NDRC, the National Development Reform Commission, there's the Ministry of Finance, there's the Party too. So the hope here was that there was going to be a coordinated response from central government to provide fiscal support for the economy. And really, I'm afraid what we've seen over the past week or so is that there's not been much coordination. We've had various different press conferences held by various different parts of the government. There doesn't seem to be much of a kind of joined up plan here. And it's not difficult. This stuff isn't difficult. I don't think the market's looking for much here. It's looking just for a sense of the fact that all parts of government are pulling in the same direction, are on the same page, and that there's a reasonable degree of fiscal support that's heading the economy's way. Now, the stimulus that we've seen and the measures that we've seen announced so far, are significant insofar as they will give a bit of a boost to activity over the coming quarters and into 2025. And as a result of having a slightly stronger start to the year next year than we had previously anticipated, we've pushed up our forecast for economic growth, at least on our China activity proxy measures. That's our own independent measure of economic activity in China. We now expect on that measure that the economy will grow by about 4.5% next year compared to our previous forecast of 4%. That's reflecting the stronger start to the year. But it's this idea that there's a lack of coordination between the different arms of government that I think is the bigger concern in markets. Now, all of this could be coming. There's a bureaucratic process by which they have to approve fiscal measures, and there's a meeting of the Standing Committee of the National People's Congress, which is the legislature in China, which is the body that approves these measures. That's coming over the second half of this month. So it's possible that we start to see some coordination emerge further down the track. But as we stand now, today, I think it's that lack of coordination between the different parts of government that's going to be a cause of concern for markets, because it gives this sense that the support is being implemented in a slightly disjointed manner.
Stepping back, it does feel like people got far too excited about Tuesday's press conference, certainly, and then this press conference today. It seems to be coming back to this moment during the global financial crisis where Beijing panics. It launches this 4 trillion yuan stimulus package. And that creates this expectation for the kind of rescue, the kind of intervention that you get when growth falls below target. And so markets have come to expect some kind of intervention when things get dicey, don't they?
China's in a very, very different place to where it was in 2008. So it's a very different economy. We've had another 15, 16 years of incredibly high rates of investment. So China's capital stock is substantially more developed than was the case in 2008. And it's the nature of the stimulus as much as the size of the stimulus that matters. So that's why the measures for households were potentially so important, because back in 2008, that 4 trillion package was all about really pummeling money into infrastructure and investment. And 16 years on, after sustained high rates of investment, China doesn't need that so much. And in fact, to the extent that we do get more investment, what's called the incremental capital output ratio, so the bang for the buck that you get in terms of GDP from an extra unit of investment, has diminished substantially. So it's getting less bang for its buck from investment. So it's the consumption measures that matter. And so I think that the economy is in a really radically different place to where it was in 2008. So it's not just the size of the package, it's the composition of the package and the fact that it's coordinated across these different arms of government. And on those last 2 points, the composition and the coordination part, there's still some big questions unanswered and some big doubts remaining.
Well, the market response on Monday is going to be interesting, that's for sure. The team will obviously be all over that, giving their analysis. But I wanted to move on to the Fed, because it does seem that the debate there has shifted in interesting ways in recent weeks. We had that big 50 basis point cut to kick off the easing cycle. That seems to have stoked expectations for similarly sized moves going forward. Then we got payrolls. We've had a few other releases as well, which all show that actually the US economy still seems to be running pretty hot. Now we've had these hurricanes in Florida and neighboring states. Obviously, there's a tragic human element to all of that. But the fact is, when we get extreme weather events like this, there are inflation implications, aren't there, which can't be ignored. So putting it all together, I mean, never mind the idea of another 50 basis point cut from the Fed. Is there a case for them not cutting at all come November's meeting?
Well, I think it always pays at moments like this just take a step back and think about the bigger picture. I mean, it wasn't so long ago, probably 6 weeks ago on this podcast, where we were discussing concerns about an imminent slide into recession in the US, and the fact that many people in the market were talking about the need for emergency rate cuts ahead of September's FOMC meeting. They should be cutting by 150 basis points immediately. Now, that, to our mind, was overdone. And equally, I think the idea that the economy is resurgent and inflation is about to surge on the back of one relatively strong payrolls release and a modest pickup in some of the CPI numbers, month-on-month CPI numbers, I think that's overdone too. So throughout this, if you look at our US macro scenarios dashboard, it's always pegged a soft landing as the most likely outcome. And I think, frankly, our judgment in that regard has not changed. Now, you're right, we've had a barrage of inflation data over the past week, CPI data, PPI data. We put all of that together. We think that the Fed's preferred core PCE deflated price measure increased by about 0.24% month-on-month in September. We'll get that data later this month, which would be a 2.9% annualized rate, which represents a pickup from the rates of increase that we've seen in July and August, when both of those numbers were below 2% on an annualized basis. So I think there's some evidence that inflation pressures in the US have been a bit stronger in September, but it's 1 month's worth of data. With that being said, there was certainly a case in Q2 and early Q3 when we looked at the incoming data and we looked at the way the economy was evolving, and we thought the risks to inflation lie to the downside in our mind. Now I think it's fair to say those risks are a bit more balanced and may have tilted a bit more to the upside, not just because of what's been happening to global energy markets, but as you say, hurricanes and some of the labour market data has perhaps been a bit stronger than we had anticipated. So I think that the risk to inflation probably picked up a bit, but not dramatically so. And I don't think this means that the 50 basis point cut in September was a mistake. I think the data is probably not strong enough to prevent the Fed from cutting by another 25 basis points in November and December either.
Before you go, I just want to ask you about the ECB's October meeting. That's happening this Thursday. What are we expecting there?
So policymakers have pretty much told us they're going to cut by 25 basis points at the meeting later this week. Christine Lagarde has said that the latest developments strengthen our confidence that inflation will return to target in a timely manner and that they'll take that into account at their next policy meeting in October. Isabel Schnabel said that a sustainable fall of inflation back to our 2% target in a timely manner is becoming more likely. You put all this together and combine it with comments from other governing council members, and I think a 25 basis point cut is pretty nailed on and indeed is now fully priced into markets. The Eurozone is in a very different position from the US. Inflation is coming down. It's been a bit slower to come down, but the economy, the real economy, is substantially weaker. And of course, there's enormous risks around the fiscal positions of various countries, not least France, where we've finally seen a budget agreed, but the situation there is pretty delicate. So the situation for the ECB is arguably more complicated than that facing the Fed. Our judgment is 25 basis point cut at every meeting through the end of Q1, probably. So they're not going to be doing monster 50 basis point cuts because, as I say, inflation is edging down, but it's not collapsing. By the same token, it is pretty clear that the real economy needs a bit of support. So yes, I think 25 basis point cut in October. Key thing then will be on the post-meeting communications, and I suspect that will signal more rate cuts to come. And our view is a 25 basis point cut is likely in every meeting through to the end of Q1, as I say.
Neil Shearing there on Chinese stimulus as well as the next steps from the ECB and the Fed. I'll add all relevant China analysis to the podcast notes as well as our preview of the upcoming ECB meeting. Our Europe team will be online for a drop-in. That's one of our short-form online briefings on Thursday, shortly after Christine Lagarde's press conference, to take questions and highlight key takeaways from the latest communications. One day before that, on Wednesday, there's a whole series of monetary policy decisions taking place in Asia, and the Asia and Markets teams will be online at 9:30 London, that's 4:30 Singapore, to talk through what happened, and there'll also be a rep from our China team on as well if you have specific questions about the stimulus package and its growth implications. Now, one notable thing about China is that a lot of people made a lot of money out of the commodities boom that came with its growth run in the early 2000s. This was a time in markets captured by that much-shared statistic about how China poured more concrete in 3 years than the US did over the whole of the 20th century. But, as Neil discussed, China's growth boom is over. India is now the market's darling. But do forecasts for rapid Indian economic growth in the coming decades signal that it's going to trigger another China-style surge in commodities prices? Capital Economics' Joe Maher has been looking at this question, and I spoke to him earlier this week, along with Deputy Chief Economist Shilan Shah. Here's that conversation now, and it begins with Shilan talking about how we expect India to grow compared with China's experience.
The short point is that we don't expect India's economy to grow as quickly as China's did after it had reached a similar stage of development. So measured on our proprietary China activity proxy, China's economy grew on average by 7.5% from 2000 until the eve of the pandemic. And there was a period within that in which the economy was growing by rates of over 10%. Now, we think that India's growth isn't likely to match that. And to be fair, most economies throughout history haven't been able to sustain those types of growth rates. Really, that's been the preserve of the manufacturing powerhouses in East Asia. Now, when it comes to India, we think that it can sustainably grow by around 6% a year over the long term. That will still leave it among the top 1/3 of performers at its stage of development. And part of that is down to its very strong demographics, but it's also a reflection of faster productivity growth too. I think there's also an important distinction to be made around the structure of India's and China's economies too. India's economy is dominated by its services sector. It's got a very well-known and world-class business process outsourcing sector, for example. And meanwhile, its industrial sector only accounts for around 25% of its GDP. And really, that's been the case for much of the past sort of 60 years or so. Now, by contrast, China's industrial sector has historically been responsible for around 40% of overall economic output. And if we cut the GDP cake slightly differently, it also shows that investment has been a far larger share of China's economy than India's since at least the 1990s.
Okay, so Joe, similar growth hype to China, but different economic profile. Given what Shilan said, talk about India's commodities demand now and what the structure of its economy suggests about how that demand is going to evolve.
Yes, so the differences in structures between India's and China's economies have major implications for their relative commodity demand. Industrial activity is highly commodity intensive. Just think of all the metals that are required to make the machinery in the factories and all the energy that's needed to power them factories. So a country that is the size of industrial sector as China does consumes a lot of energy. It consumes a lot of metals. India, on the other hand, does not possess an industrial sector of that size. As a result, it consumes relatively fewer metals, energy. It's still, given its large population, it consumes a lot of agricultural, such as wheat and rice. Now, moving forward, given the EU projects that India's population is about to grow by around 350 million by 2050. I mean, to put that number into context, that's about double the growth in population in China from 2000 until the present day. So, yes, as you would expect, more people means more commodity consumption, and therefore it's fairly certain that to say that, India's agricultural demand will continue to grow.
So I think, your report does a good job of highlighting how demand for commodities like steel and zinc, India's demand, have grown strongly, but as a percentage of global consumption, in other words, its ability to move the dial on global prices, it hasn't actually been that impactful. But then given what you're saying about that population growth, about those extra mouths to feed at its very basic level, what does that imply about which commodities will be in demand? I mean, it sounds like just, long wheat, long rice, and everything will take care of itself after that.
I think the key point to make is that India is no China, right? One, we don't expect it to grow as quick as China did over the last 30 years. And two, so we just previously discussed the two economies that structure very differently. So if you put it in this context, I think it shows we're not going to have a repeat of the kind of China-led commodity boom that we saw in the 2000s when commodity prices skyrocketed, and some have even argued that China's rise has brought about what is called a commodity super cycle, which is usually comes about from kind of a massive increase in demand, causing a sustained increase in commodity prices. So I think given the differences in India's and China's economy, I think it's fair to say that India will not be such an exogenous shock on commodity markets as China was. But that is not to say that India won't have an impact on commodity markets. So the UN's projected rise in India's population points to its wheat and rice consumption increasing by over 50% by 2050. And this would mean that India would be responsible for around a quarter of the world's rice consumption. It's about 20% currently, and over 15% of global wheat consumption from just over 10% at the moment. I mean, we've discussed agriculturals, but you can also look at India's energy demand. I think it's reasonable to assume that India is probably going to be one of the last countries standing with a reliance on coal. So while many countries have been phasing out coal power plants, India is still expanding its own coal capacity to help power its economic growth. And I think we can also expect India's oil consumption to continue rising, as one thing about as countries get richer, and we've seen this in India over the past few years, motor vehicle ownership increases as transportation habits change. So I think it's reasonable to assume that India's oil consumption will continue to grow as its motor vehicle population rises as well.
There's an important point here that's worth stressing. You just said that we're not going to see another super cycle in commodities, similar as we saw in China in the early 2000s, as a result of India's economic development, that we will see increased demand in certain commodity categories, but not across the broad swathe of categories. Is that a fair take?
Yeah, so we don't expect India's economic rise to lead to a super cycle as it did in China's case, as that also depends on the supply side of things. So obviously, what impact India's commodity demand growth will have on prices will depend on the ability of supply to keep up with demand. And with regards to agriculturals, whilst, yes, for sure, India will go on to consume a lot more agriculturals, it also actually grows a lot, and its share of global production has been trending upwards for some time now, actually. So, no, it could be the case that impact on prices from an increase in demand is cushioned by an increase in supply. So I think, of course, the demand story is also important, but it's also key to think about what's going on the supply side of things.
Okay, thanks, Joe. Thanks, Shilan. Shilan, before you go, we've just had a decision from the New Look RBI Monetary Policy Committee. September inflation data are due on Monday, and you're forecasting a slowdown in near-term economic growth after a pretty spectacular run. Putting all that together, what is the policy outlook for India into 2025?
Yes, so the Reserve Bank met this week. It voted to keep the repo rate unchanged at 6.5%. Now, that was largely as expected, but what I think was more interesting was the less hawkish tone of the communications. That included a change in the official policy stance to more sort of neutral language. Now, over the near term, as you mentioned, we do expect a slight softening in growth. We do also generally expect inflation to remain contained too at rates sort of close to the RBI's 4% target, albeit that there will be a rise in the September reading to something like 5%, but it should fall back gradually over the coming months back down to 4%. So what this means is we think that the conditions are in place for policy loosening to begin at the next MPC meeting, which is in early December. We've got even more sort of conviction in our view now that there'll be a 25 basis point cut in the repo rate in that meeting. The consensus is currently split between a cut and a hold for that meeting, but we do suspect that this week's communications from the RBI will see other analysts revise their forecasts over the coming weeks.
That was Shilan, Shah and Joe Maher on Indian commodities demand and the RBI's next steps. I'll add Joe's report and our latest RBI analysis to the podcast notes. Shilan will be on that Wednesday drop-in about policy easing in Asia if you have any India questions for him. But that's it for this week. I'll be back next week with more on global macro and markets, including a closer look at all these headlines about the end of the EV sales boom and what that means for global oil demand. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.